Something very important just happened, and most people don't realize how much it could affect them. The IRS has officially announced the start of the 2026 tax filing season, and on the surface, it looks normal. Same time of year, same process, same forms. But here's the truth. Most headlines aren't telling you. This tax season does not work the way it used to. And if you file the way you always have, especially if you rush, you could end up waiting weeks or even months for your refund, or worse, dealing with problems you never saw coming. This matters more than ever because for millions of households, a tax refund is not extra money. It's survival money. It pays rent. It covers medical bills. It clears credit card debt. It fills the fridge. It creates a small cushion when prices everywhere are still painfully high. Now, let me ask you something and be honest. When you usually file your taxes, are you the type who files the minute your W-2 hits your inbox, or do you wait until later, closer to March or even April? Drop your answer in the comments because this year, timing could make or break your refund. January 26 is the first day the IRS will officially accept and process tax returns for the 2025 tax year. That date marks the start of the 2026 filing season. Mark it. Remember it. But also understand this. January 26th is not a deadline. It's not a race. And filing first does not mean getting paid first. So why is this year different? Behind the scenes, everything changed. There are major tax law changes now in effect. There are significantly fewer IRS workers than last year, and there's a major shift happening in how refunds are paid, with paper checks slowly being pushed out. Each of these changes alone would make filing season more complicated. Together, they create a perfect storm where small mistakes turn into long delays. And here's what really catches people off guard every year. New deductions can help you, but those same changes can also quietly work against you if you don't understand them. That overlap, where opportunity and risk collide, is exactly where most people get burned. This year especially, filing too early or filing without fully understanding what changed can cost you time, money, and peace of mind. And the biggest reason for all of this? A brand new tax law. Last summer, President Donald Trump signed a sweeping piece of legislation officially called the One Big Beautiful Bill Act. Yes, that's the real name. And while the name got laughs, the impact is no joke. This law rewrote major parts of the tax code. Deductions changed, credits shifted, income thresholds moved, and every single one of those changes applies to the return you're about to file right now. On paper, many of these changes sound great. In real life, they add complexity, especially if you're not prepared. Here's where things get interesting. For the first time ever, there are new deductions for income that was never deductible before. We're talking about tip income, overtime pay, certain car loan interest. That sounds like a win, right? And for many people, it is. But the way these deductions interact with employer payroll systems and IRS processing is where trouble starts. Most employers did not update their withholding systems after the law passed. That means taxes may have been taken out of your paycheck all year based on old rules. You might have overpaid without knowing it. That could mean a bigger refund, but it also increases the chances of mismatches, flags, and delays. And with fewer IRS employees reviewing returns, anything that looks even slightly off can slow everything down. This is not the year to rush. This is the year to understand, because what used to be good enough accuracy is no longer enough. This year, accuracy needs to be almost perfect, and that's just the beginning. In part 2, we're going to break down the new deductions that could put thousands of dollars back in your pocket and the exact mistakes that could cause the IRS to freeze your return. Don't miss it. Part 2, new deductions that can help you or hurt you. Let's talk about the changes everyone is excited about and why they're also the most dangerous if you don't handle them correctly. Under the new tax law, workers who earn tips may now deduct up to $25,000 of tip income. Think about how big that is. Servers, bartenders, delivery drivers, salon workers, millions of people fall into this category. For many, this could dramatically lower taxable income. Then there's overtime pay. If you regularly work more than 40 hours a week, you may be able to deduct up to $12,500 in overtime income. That's huge for people who rely on extra hours just to stay afloat. And for the first time, there's a deduction for auto loan interest up to $10,000 under certain conditions. This works a bit like the mortgage interest deduction, but applies to car loans. That's a big shift in how the tax code treats everyday expenses. On the surface, this all sounds amazing. More deductions mean less tax owed or a bigger refund. But here's the problem most people don't realize. Payroll systems were never updated to reflect these changes. Employers kept withholding taxes as if these deductions didn't exist. That means your W-2 might not line up cleanly with the deductions you're now allowed to claim. And when numbers don't line up, IRS systems notice. Sometimes that just means a delay. Other times it means your return gets pulled for manual review. And with the IRS operating with 25% fewer employees, that review can take a very long time. This is why tax professionals are repeating the same message over and over this year. Don't rush. A mistake that might have taken 2 weeks to fix last year could take 2 months this year. And it doesn't stop there. The standard deduction also jumped significantly. $1,850 for single filers, $31,500 for married couples filing jointly. This affects almost everyone because most taxpayers don't itemize. That increase alone could reduce taxable income for millions of households. The child tax credit increased too, now $2,200 per child. For families with multiple children, that's real money. Money that can help with school costs, clothing, food, or child care. Then there's the SALT deduction, which affects people in high-tax states. The cap jumped from $10,000 to $40,000, at least through 2029. For certain middle and upper middle income households, that could mean savings of over $1,000 this year alone. So yes, there are real benefits here, but every benefit comes with rules, documentation requirements, and income limits. Claim something incorrectly and your refund could freeze. And here's the kicker. The IRS says their systems are ready, but their people are not. That's not fear-mongering. That's reality. In Part 3, we're going to talk about the IRS staffing crisis, refund delays, and why direct deposit is no longer optional for many taxpayers. This part is critical if you rely on your refund money. Part 3, IRS delays, refund changes, and why paper checks are dying. This year, the IRS is entering tax season with roughly 1/4 fewer employees than last year. That's a massive reduction. Departments that handle processing, phone calls, letters, and problem resolution are all smaller. That means one thing for you. Mistakes hurt more this year. Even a small error can put your return into a waiting pile with thousands of others. And once it's there, it could sit for weeks. Customer service is also slower. Last year, average phone wait times were already over 30 minutes. Some people waited hours. This year could be worse. That's why preparation matters more than speed. There's also a major change in how refunds are paid. The IRS is actively moving away from paper checks. Direct deposit is now the default. If you don't provide bank information, you may receive a letter asking for it. Paper checks take longer, get lost, and create fraud risks. Direct deposit is faster and safer. Most refunds arrive within 21 days when everything is clean. If you've always used paper checks, this might be the year to switch, even if it means opening a basic bank or credit union account. Now let's talk about timing. A lot of important tax documents don't arrive in January. Energy credits, EV credits, retirement contribution confirmations. Many show up later. Filing early without them increases the risk of amended returns. And amended returns are a nightmare this year. What used to take 8 to 12 weeks could now take 4 to 5 months. There is no prize for filing first. There is no bonus. April 15 is still the deadline, and extensions are still available. In Part 4, we'll break down exact steps you should take right now, what to do if you owe taxes, and how to protect yourself from costly mistakes. Part 4, the smart way to file in 2026. Let's bring this home with clear, practical steps. First, gather everything before you file. All W-2s, all 1099s, all receipts. Don't guess, don't estimate. Waiting a few extra weeks can save months of stress. Second, understand which deductions actually apply to you. Tips: over time, car loans. Read the rules carefully or talk to a professional. Third, set up direct deposit. Double check the numbers. One digit wrong can delay everything. Fourth, use software or a professional if your situation is even slightly complex. The cost is often far less than the cost of mistakes. Fifth, review everything before submitting. Social security numbers, bank details, income totals. Take the extra 15 minutes. If you owe taxes, file anyway. Pay what you can. Set up a payment plan if needed. Ignoring it only makes things worse. If you're self-employed, drive for gig apps, earned crypto, collected unemployment, or received advance credits. Double-check reporting. The IRS is paying close attention to these areas. And finally, remember this: a big refund isn't always a win. Sometimes it just means you overpaid all year. Consider adjusting your W-4 going forward. This tax season is not about speed. It's about precision, patience, and preparation. If this helped you, drop a comment and share how you handle tax season. Your questions help shape future videos. File carefully, file accurately, and don't let this new tax season catch you off guard.